blindsided, willful ignorance, fear, and greed. They kind of knew the music was going to stop. There's this daisy chain that if you let one go, they're all going to go.
Hi guys, just wanted to let you know we'll be doing a live stream on June 2nd at 10 p.m. Eastern Standard Time to catch up with your views on past guests, current events, and of course gold and silver. Once again, join us for our live stream on June 2nd at 10 p.m. Eastern Standard Time, and I'll see you then. Hello again everyone, and welcome to another edition of Silver Bullion Television SBTV. I'm your host, Patrick Vieira. Before we start, once again, if you are new to this channel or have not done so, please do subscribe, click on the bell to be updated on new content, and do give us a thumbs up if you like this video. Our guest today is Jesse Felder, founder of the Felder Report. He began his professional career at Bear Stearns and later co-founded a multi-billion-dollar hedge fund firm headquartered in Santa Monica, California. Jesse also hosts and produces the Super Investors and the Art of Worldly Wisdom podcast. And we're delighted to have him here today as our guest. Good day, Jesse, and welcome to SBTV. How are you doing?
I'm doing great, Patrick. Thanks for having me on.
Thanks for coming on board. We're delighted to have you. Can you share with us more about your background and what led you to start the Felder Report?
Yeah, I was always interested in finance, actually, from a young age, and I didn't study that, though. I actually had a great senior year in high school. I had a great English literature teacher who inspired me to study that in college. But then when I graduated, I thought, what the heck am I going to do with an English degree? And I was always interested in finance, so I just applied in LA at Morgan Stanley and Bear Stearns and a couple other places, and the guys at Bear decided to give me a chance. And so I worked at Bear Stearns for a while there in the private client side, and ended up finding a guy there who I worked for who was basically running kind of a hedge fund within Bear Stearns. And he kind of, mentored me. We left a short while later to start our own hedge fund in Los Angeles, and I did that for a number of years. I was head trader and assistant portfolio manager of the hedge fund. Did that for a number of years before I quit the fund and moved here to Bend, Oregon. And I basically managed just some friends and family money. Until about end of 2014. And at that point, I basically said, I'm going to give everybody their money back. I don't see a ton of opportunities. I see a lot more risk than reward in the markets. And so I think probably and I'm not going to charge people a fee to kind of keep them in cash. And so I had always had this idea that I really liked doing the writing and research side of the markets better than the other side of, being an asset manager, raising money and client management and all that kind of stuff was all the stuff that never really appealed to me. So I've always been a fan of Richard Russell, who wrote the Dow Theory letters, and Bill Fleckenstein is a friend of mine, Fred Hickey. I've always kind of enjoyed that the process of researching and writing about the markets, and that's where I guess an English degree comes in handy. So I started the Felder Report. I started the blog actually back in 2005 because, believe it or not, here in Bend, Oregon, we were one of the either one or two most overvalued residential real estate market in the country in 2005. And so at the hedge fund, I had a kind of a front seat to the dot-com mania. And, got to just witness individual investors go nuts through that period because we had our own broker dealer and people were trading through us. And then the replay of that in the housing bubble 5 years later was just, it's like deja vu. And so I started blogging about that, just kind of having a front row seat to this little town here in Bend, Oregon, where I knew people that were leveraging their home equity into 10 or 12 spec properties. And it was just absolutely nuts. And so that's when I started the blog, was in 2005, to kind of chronicle that period.
Okay. So, I guess I'll need to ask, being a part of Bear Stearns, how do you feel about what went down with Bear Stearns back in 2008?
They essentially became insolvent overnight. And so it was interesting to me to be kind of I actually just wrote about this this past weekend. How there were plenty of people warning about the impending financial crisis, at least a housing bust, and then what all that leverage would kind of mean for the banking sector. Personally, I shorted Bank of the Cascades, which was one of the biggest local bankers here in Oregon, because I saw the loans they were making to a lot of these houses, but you watch The Big Short, there were plenty of people that were paying attention to what was going on and really warning about it. But then you have, the big banks like, Bear and Lehman who, kind of claim that they're entirely blindsided. Bernanke said completely blindsided by this housing bust and financial crisis. And so to me, it was, that's just willful ignorance. I mean, there's, I think it's maybe it was the guy, I'm spacing on his name right now, who ran Lehman at the time, who said, you have to dance while the music's playing. And that's basically all it was. Is, they kind of knew the music was going to stop. They knew there was going to be a problem. But the greed, pushing people to try and continue to make money so long as they could was what, was really problematic then. And so to me, that was really the only thing I take from that is, yes, when you see these cycles, through time, when you see them kind of, you get to a point in the cycle where things, become troublesome, you might, run the risk of becoming too conservative too soon. But that's always way better than trying to, do it too late. And so, I think that's a lesson that, people should take from that is that, even the biggest in the business, fall prey to those emotions of fear and greed, and in this case, it was greed.
Yeah, the biggest in the business, we saw some of them get bailed out, and we saw others didn't get bailed out, like Bear Stearns. Why? What's your take on why Bear Stearns didn't get a bailout?
Well, I think they did end up getting bought out, and I think that's kind of what some of the Fed was trying to do, was help other banks take over these failing banks. But yeah, I mean, it was interesting. I think they were the first to really become distressed, and I think the Fed was probably in the Treasury. Everybody, powers that be, were under the impression that, okay, let's let these guys go under. We'll work it out. We'll sell them to J.P. Morgan, and we'll see what happens. But then when it became clear that letting Bear go means now Lehman's going to be in trouble, and basically there's this daisy chain of interrelated derivative exposure that if you let one go, they're all going to go. That was the wake-up call. And so I think they let them go just because they were the first, and whoever was the first to go was going to be let go because they just didn't understand those risks.
Okay, yeah, I had to ask that question because there's a theory floating around that because Bear Stearns didn't play ball when long-term capital got in a bit of trouble, that Bear Stearns didn't get bailed out.
Yeah, no, I mean, obviously, I don't know for sure. I wasn't involved. I was I had left Bear 10 years before the financial crisis, so I had no idea what was going on. I'm just guessing. To me, from following the storyline and the reaction and what the Fed was saying and the Treasury were saying at the time, it just seemed to me like they didn't realize the extent of the problem, and that's why we'll just let Bear go under and kind of see what happens.
Given that you've managed money for more than 20 years, I hope you can help us understand money better in the context of our modern financial system. Money that is deposited into a bank account, does it belong to the depositor, or us basically, or is the depositor now owed that sum of money from the bank?
Well, I mean, that's the fractional reserve banking system that we live in, which is, I mean, that it's been that way for a long, long time. And I try and explain it to people by saying, go back and watch It's a Wonderful Life, and it's the Bailey Building and Reserve, I think, is what it was called. The storyline in the movie, the famous, Christmas movie, is, people want to show up and pull out their deposits, and they have to explain to them, wait, look, your deposits, we don't just keep all your money in the safe in the back. We loan it out to all of our other customers in the form of a mortgage, and your deposit is in this guy's house over here. And I mean, that's just how it works. And so Yeah, I mean, it really is, the bank owing you that deposit. That said, the FDIC does insure those
Yeah.
deposits to whatever it is, $250,000, $300,000 limit or something like that. So, what I tell people is as long as you're under the FDIC limits, not to worry about it, but you don't want to deposit, more than that in cash, because then you're just, completely reliant on the solvency of that bank.
Yeah, I hear you. I read a post from the Felder Report website titled "The Perils of Pursuing Monetary Policy That Explicitly Makes the Economy Reliant on Bubbles." Interesting read, and we'll put that link in the video description. But what do you mean when you say that the economy is reliant on bubbles? Do you mean that the fueling bubbles has become a natural consequence of monetary policy undertaken by central banks?
Yeah, I think it's absolutely that the Fed is now using asset prices to try and manage the economy. And, they can't come out and say, over the last 10 years, we were trying to create a wealth effect by pursuing quantitative easing and zero interest rate policy. We're trying to create a wealth effect. They're basically saying we're trying to push up the values, the prices of financial assets to make you feel more wealthy so you go spend more money. And, it was so interesting to me because, the Fed explicitly did this after the dot-com mania burst. They explicitly tried to create this housing bubble and create this wealth effect. And then after the bust, the quote that I used at the beginning of that was from a video interview with Janet Yellen.
Right.
That was actually recorded during when my friend Bruce made Money for Nothing. It's about the Fed's role in the financial crisis. And that excerpt didn't make it into the final cut of the movie, which is a great documentary film. But it was fascinating to me that, Janet Yellen said we need to find a way to move the economy to, basically being supported by its own fundamentals rather than being supported by bubbles. And then she becomes the Fed, and what does she do? She pursues these wealth effect policies that essentially make the economy entirely reliant on asset prices. And so it's a really difficult position the Fed's in right now because, they want to normalize monetary policy, or at least they have over the last couple of years, but they also recognize that this extraordinary monetary policy is what created this boom in asset prices. And now if we normalize, we risk kind of bringing it all back to earth. And so it's a tough situation.
Yeah, the Fed, they're definitely heavily involved. Can you share with us how the Fed's control of interest rates has a profound effect on investors searching for yields?
Yeah, absolutely. And this is one of the biggest risks I think investors are making unknowingly today. When they lower interest rates to zero on your savings account, short-term treasuries go to zero or very close also. And so investors are forced, if you're living on a fixed income or something like that, investors are forced to say, okay, well, I can't, buy CDs anymore. I can't buy short-term treasuries anymore. I have to maybe buy junk bonds, or maybe, I have to go buy some high dividend paying stocks. And I think this reach for yield that we've seen during this cycle is probably greater than anything we've ever seen because interest rates have been lowered to zero for so long. Yeah. And so I think there's a ton of investors out there that have bought, high dividend paying stocks or junk bonds or, the like without, and we've seen this actually. Selling volatility is another one of these trades that's, I'm trying to generate income. So I'll go short volatility, or I'll sell put options, or, right, sell options in order to try and generate income. There's all kinds of crazy things investors have been doing during this cycle to try and generate income without having any appreciation of just how much risk they're taking.
Yeah. I mean, with that in mind, do you expect the economy to give the Fed reasons to cut rates again this year?
Well, I'm on the longer term kind of impression. I'm working under this thesis that I think inflation is making a comeback, that this trend of disinflation that we've seen since the early 80s really kind of probably came to an end in the last few years. I think that low in the 10-year Treasury bond in summer of 2016 was probably the low for interest rates. And I think the low for inflation too. And I think the thing to me that really kind of bolsters this view is that both monetary and fiscal policy are moving, towards inflationary types of not just rhetoric but actual policies. And so you see fiscal authorities talking about things like $2 trillion infrastructure spending bill here in the United States, and then potentially paying for that by printing, essentially having the Fed buy up all the new debt that's required to. So it's essentially monetizing the debt, and people are not worried about the fact that we already have a $1 trillion deficit, and it's growing. And then you have the Fed talking about Jay Powell saying things like low inflation is the biggest challenge of our generation. And you think about that's the complete opposite of the Volcker Fed, which was it's our job to keep inflation under wraps, and inflation was the biggest challenge of his generation. And so you see this flip-flop now where the Fed is, instead of biased towards keeping inflation in check, they're now biasing towards higher inflation. You see the same thing by the fiscal authorities. And to me, this is the Fed may be forced to cut rates in the short run, but I think these inflationary pressures are really starting to build, and the pricing pressure from just the trade war, these new tariffs and things are going to make the Fed's job even that more complicated, because if inflation picks up even while growth is falling, I think we are either already witnessing or we're at the precipice of stagflation once again right now. And so the Fed may want to cut rates to help the economy, but if pricing pressures and wage pressures and all these other things are becoming problematic, it might tie their hands so they actually won't be able to cut. But we'll see.
We'll see. Yes, we will. You also described in your post the craziness of the current credit cycle to be the most Ponzi of all the Ponzi finance stages of all time. Help us understand why the situation is that dire that you call it the most Ponzi of all the Ponzi finance stages of all time.
Yeah, well, that Ponzi finance stage idea comes from Hyman Minsky, who wrote about the credit cycle. And he really was kind of unknown economist until the financial crisis. And then after the financial crisis, people went, wow, this guy was writing about this for decades in the lead up to the crisis and has some very important concepts. So one of those is this credit cycle that in the very beginning, the early stages of an economic rebound, the credit cycle is very conservative. Actually, lenders are very conservative. They only lend against hard assets, and all loans are essentially collateralized, and so lenders aren't really taking much risk. Then you move on to the next stage of the credit cycle where lenders will loan against income. And they'll say, okay, well, we'll lend you this much money. It's, 5 times income. You'll be able to pay us back in 5 years. That's not too worrisome. The third stage of the credit cycle is what Minsky called the Ponzi stage, which is you lend to companies that have no hope of paying it back, that the only way that loan will get paid back is if they refinance it before it matures. So essentially, they don't have the assets or they don't have the income to ever pay those loans back. And so in this stage during this credit cycle, we've seen the number of zombie companies in the S&P 500 or the Russell 3000, whatever you want to look at, the percentage is the highest in history. And the way you define a zombie company is a company that doesn't earn enough operating income to cover its interest expense. So it can't even, pay interest on its debt. It's something like, 14% of the Russell 3000 or something like zombie companies right now. It's the highest percentage in history. So these companies that are so highly indebted, I consider that, that percentage of zombie companies to be indicative of how far this Ponzi stage has gone. And investors have become, due to this reach for yield, like you mentioned, Patrick, so comfortable lending to zombie companies, probably through passive products and other things that they don't, necessarily understand the risk they're taking, that it's just grown like never before to a greater percentage of the market than we've ever seen before.
Yeah, I mean, zombie companies, is the current situation even more crazy now than in the years leading up to the 2008 financial crisis?
Well, it's totally different. I mean,
Okay.
then we were lending to zombie homeowners, right? People who didn't have the personal income to support the debt that they were taking on in terms of buying residential real estate. Today, it's much more. I'm much more concerned about the corporate sector.
Yeah.
It seems like the consumer's not nearly as leveraged up as they were, but a lot of people look at that, holistically. I think the consumer is more leveraged up than most people appreciate. It's just not mortgage debt this time. It's auto and credit card loans, and especially autos. And we're starting to see deterioration in auto credit. But so it's different. This time it's much more focused in the corporate sector. And you have companies that have leveraged up the balance sheets a lot of times just to buy back stock. And so there's no asset, to offset the liability on the balance sheet. When they're doing that, when they're borrowing to buy back stock. So it just creates a much greater deal of leverage on the balance sheet for these companies. And, it's fascinating to me to see companies like McDonald's and Boeing and 3M that I've, written about in the last couple of years that are these, old blue chip companies that are wonderful businesses, but they're all trading at their highest valuations in the history of these companies that have been around for decades. And a lot of that is just because they've taken on a ton of debt to buy back the stock, which has pushed up the valuation. But look at a company like Boeing, who's now having the 737 issues, and leveraging up the balance sheet might not have been a great thing to do. I mean, obviously you can't foresee this risk kind of coming, but McDonald's is another one. They leverage up the balance sheet to buy back stock. And, there's always cycles of business risk. And so it's very just short-term oriented thinking that you see at these companies right now. And it's really, to be blunt, the way I think about it is corporate management's trying to maximize their ability to cash out options and those kinds of things. They're really, there's been some talk about in Washington regulating this, or at least, coming up with some rule where insiders can't sell stock at the same time they approve buybacks. You have to have some type of if you're going to approve stock buybacks, then you have, your insider selling window is going to close for 12-month period until you're done buying back, and then you can sell, because it's so obvious that, when buybacks are happening, statistically, insiders are 3 times more likely to sell. So let's leverage up the balance sheet to cash out for the top execs, and it's, it should be regulated, I think.
When do you think this Ponzi scheme will end, and what impact do you think it's going to have on the average Joe, the man on the street?
Well, I think there's 2 things. So the big risk that I see is the leverage in corporate America, and people have said, Steve Eisman, who was, one of the guys featured in The Big Short, came out and said, the next recession is when this is really going to become a problem. I think it might not take a recession to become problematic. We're already seeing, one of the things I think both equity and corporate debt investors don't appreciate right now is that corporate profit margins are inflated to their highest levels in history. And so when you use a price earnings ratio, that earnings, the denominator in that equation is inflated more than it's ever been before in history. So your PE is going to look a lot lower than it really is. If profit margins revert to their mean, to historical means, you're looking at a 40, 50, 60 PE on the S&P 500, which is higher than the dot-com mania. But Ray Dalio and Bridgewater have done some work and kind of been talking about this recently. We're drawing some attention to it, but I don't think corporate debt investors appreciate what this means to them, and that all this debt is built on the income that corporate America can generate. And if that income is inflated by profit margins, then as soon as profit margins revert, that means all of that debt becomes immediately unsustainable. So you don't necessarily need a recession. You just need a profit margins reversion to mean. And how does that happen? Slowing top line growth and pressure on the bottom line, usually through rising expenses, wage pressure, or other costs of doing business. And that's what we're seeing right now. We're now seeing the first reversion, 2 quarters reversion of profit margins since 2015-16. That's when profit margins really started to revert. And then we got the corporate tax cut. which created like a temporary reprieve for companies that were facing these cost pressures. But now these cost pressures are coming back again, and we're starting to see a reversion in profit margins. And I think this reversion, even without recession, could start to put pressure on the corporate credit markets, because companies that are seeing the greatest, wage pressures and other costs, of doing business, and then, from the tariffs, like I said, before, that is going to be increasing cost pressure to corporate America. It could quickly make a lot of these over leveraged companies insolvent, just like we saw during the financial crisis.
Yeah. Okay. We touched a bit on buybacks. You're also of the view that repurchases have been consistently been the largest source of U.S. equity demand, and without company buybacks, demand for shares would fall dramatically, just as we've been talking about. Do you mean that the stock markets are way overvalued and propped up by this artificial demand?
Absolutely. I mean, if you look at, one of the best ways I think to value the stock market, and this doesn't come from me, but Warren Buffett in 2001 said the single greatest valuation measure of the stock market is market cap to gross national product. And you basically just take the total value of the stock market compared to the size of the economy, and you'll know if things are, cheap or expensive. Today, we're at, the highest level. We're essentially at the same level we were at the peak of the dot-com mania in terms of valuation. And we're higher than we were in 1929 before that crash. So the value of the stock market, the valuation, I should say, is, as high as it's ever been in history. By some measures, it's even higher than that. So yes, it's been the reason it's gotten here is from buyback activity, buybacks that were enabled by super low interest rates created by the Fed. So, I think it's, and I say that in terms about the buyback activity because when you look at all the different flows into equities, and the Fed, provides tools to look at this, the net flows from individual investors have been zero. There's been money that's gone in, money pulled out, and so the net inflows have been zero. There, been flows from foreigners in and been back out again. But I think a lot of, the money thing that's supported the U.S. stock market too is Japanese and European money facing negative interest rates at home coming into our corporate bond markets, which, right? I mean, how do you give money to these completely over indebted companies so they can buy back stock? Well, if you can get 3, 4, 5% on a yield, if you're facing negative interest rates at home in Japan or Europe, that looks attractive. So there's been a lot of money that's actually flown in, but there's not been any money invested in the stock market other than buybacks over the last 10 years. It's literally been the only net demand for equities has been from the corporations themselves, and corporations famously. You look at any history of buyback activity in gross, and it's they buy back the most stock at the top when they shouldn't be buying, and when stocks are cheap, buybacks disappear. And we've seen record buyback activity in the last couple of years. Another thing that was enabled by the corporate tax cut.
I think we're all pretty much in agreement that equities are overdue for a pop, but how much more air do you think can be blown into the equities bubble?
It's funny. People were talking about a melt up. We could be on the brink of another melt up in the stock market. I really think that it was December 17, January 18 was the melt up. And there's a lot of different things you could look at. Market just went straight up for really, in anticipation of the tax cuts, but it was really, that was the euphoric blow off in my mind. And you look at, any types of sentiment signals and all those kinds of things. And that was when people really got truly euphoric in that run up. And we're essentially have gone nowhere since. The market today is right where we were back in that January, February 2018 time. So we've gone nowhere in almost, 16 months, something like that. And, that should be a message to investors. People look at this rally since the beginning of the year and go, wow, this is awesome. But stock market is telling you a different message when you zoom out to, an 18-month time frame and saying, things, we've gone nowhere for a year and a half. That's a little bit different message.
Okay. And earlier you touched on Paul Volcker and Jay Powell. Do you think that the reactionary hiking of interest rates by the Fed, like what Volcker did back in the 80s, would that be the pin to prick this bubble?
I don't. I think the Fed has already raised rates enough to create recession. If you look at the shadow Fed funds rate and these types of things, which add quantitative easing into quantitative tightening into the rate hikes. The amount of tightening that we've had over the last couple of years has been typically in the past has been enough to create recession, bear market, those types of things. But it's the Fed really flipped last December, and I think that was Jay Powell just becoming frightened about his own ability to reverse the wealth effect that they spent 10 years trying to create, and that just freaked him out. What I think is probably going to pop this bubble, I mean, nobody knows, but I do think it's this reversion of profit margins, and I do think it's a shift from disinflation to inflationary pressures, because that makes it so much more difficult. Most people, when they look at the stock market, they look at things, they look back maybe 20 years. So they're looking at valuations only during the dot-com mania till today, right? They're not looking at any other market environment, and they're only looking at a disinflationary environment. So it's very, very limited to have only a 10 or 20-year look-back period. When you look back further, 40, 50, 100 years, there's all kinds of different backdrops to the markets. And if we are shifting from a disinflationary to an inflationary backdrop again, that means financial assets generally are going to struggle, and real assets are going to do much better. That's kind of, like I said, the thesis that I'm working with. I do think that as it becomes more apparent to people that we are facing a stagflationary environment right now, where we're going to have very weak economic growth paired with inflationary pressures, that's probably like the worst of all worlds for financial assets, and that in itself probably could prick this everything bubble, as I've talked about. I mean, it's stocks, bonds, collectibles, all kinds of things are overvalued. More real estate again. Between stocks, bonds, and real estate, we've never seen those three together be as overvalued as they are today, all at the same time. And so to me, it's those types of things. And real estate probably in that type of environment does better than the other two. But it's not just an equity bubble. It's a bond market bubble. It's other things.
Going back to that last year December timeframe that you mentioned, I think that was when President Trump had called Jay Powell crazy also. So a little bit of heat on old Jay there. But when these bubbles pop, substantial wealth is going to be destroyed or transferred. I believe there will be that transfer of wealth from those who rode the bubble to its peak to investors who patiently bought undervalued assets. Which assets do you think will do well when this house of cards Ponzi or all Ponzi come crashing down?
Yeah, I mean, I have been bullish on gold since summer of 2015 is when I really started getting excited about it. It was around the time when I think it was Wall Street Journal called gold a pet rock. And there was just so much hate toward the precious metals generally that's usually what gets me interested in anything. Is if and there's just this consensus of hate or dislike for an asset class. Usually it means it's priced attractively. But over the past couple of years, I mean, I really do think that the real bull case is not just this shift from disinflation to inflation. It's these trends in what's going on the fiscal side of things. So, the dollar, to a great extent, trades as the inverse of the federal deficit. And so when the deficit is narrowing, the dollar does well. Actually, not the inverse. Gold is the inverse of the deficit. The dollar trades very closely to the deficit. So when the deficit's widening, it puts pressure on the dollar. Dollar doesn't do well. And for the first time in a long, long time, we're having a massively widening deficit during an economic expansion. We're already over $1 trillion run rate on the deficit, which is 5% of GDP or something. And if we get a recession, we're going to be pushing $2 trillion on the deficit, which is going to put a ton of pressure on the U.S. dollar. Not to mention the fact that you have already Russia, China, and even Europe talking about de-dollarizing and trying to break out of this, dollar, based trade system framework. And so, there's all kinds of things in my mind from a macro point of view, but also just from a, fiscal point of view that say, to me as somebody who, lives in a dollar-based currency regime, I need to do something to protect myself against, a decline in the dollar. And to me, that's having a significant portion of my assets in gold and precious metals generally. It's funny because I'm a huge Warren Buffett fan, and people say, well, Buffett says, precious metals are worthless. Yeah. And but people forget that in 1997, Buffett bought a ton of silver. He just, and basically his reasoning for it was, he said the supply demand was screwed up, and he saw, the debasement of the dollar coming. And if he had, been patient, held on to that, it would have been a great trade. I think he ended up making some money on it. He sold it in early 2000s, ended up doing well on it. But he's such a humongous investor that he can't invest in those markets. There's just not enough, physical for him to actually participate. But those same reasons, why he was buying silver then, why he was buying silver in the early 70s too. I mean, it's the same exact thing today. Yeah. The supply demand for these markets is totally out of whack, and both the Fed and the fiscal authorities are looking at ways to debase the currency. And so, to me, that it's, I think over the next 10 years, that's, where I'm going to want to be. I want to have significant exposure there.
Jesse, we got a lot of gold and silver guys who watch this program. So I think you just put a big smile on their face, and they're going to definitely be following you now. But gold, which is it? Is it money? Is it an investment? Is it a type of insurance?
I think it's a little bit of all those things. I see it as, a currency alternative, so you say, okay, well, I live in a dollar-based, economy. I have risk to the dollar. Okay, if I don't want to have risk, then I look at the alternatives. Do I want to own euros? Do I want to own yen? Those are really kind of my only other options. And you look at what those central banks are doing, and you go, yeah, no, that's not any better than what's going on with the Fed and policy here. Although I do think those currencies will do better than the dollar over the next few years. To me, the one that to protect yourself against these kinds of debasement and competitive debasement, it's you gotta own gold. That said, if you look at, to me, one of the things I look at is the gold to stock market ratio, so the gold to S&P 500 ratio, and that's also very highly correlated with financial stress. So the Chicago, Federal Reserve financial stress measure is very highly correlated to that. So when financial stress starts ticking up, gold does very well relative to the stock market. And if you look at gold and stocks over long periods of time, they usually don't do well at the same time. Either stocks are doing well or gold's doing well. And so it's usually during those times of high inflation or high financial stress that gold does a lot better than stocks. And so, people say, Jesse, well, look at gold over the last, it did great from 2000 to 2011. But if you look at it over a 50-year time frame, whatever, it maybe hasn't done great. It's protected your purchasing power. Yes. But there have been long periods of time where you've not wanted to own gold. So I think a lot of it is figuring out, okay, is this one of those times where it's a really good idea to own gold? And I think to the extent that you anticipate financial stress, it's a good time to own gold. If things are going to be, or inflation, and to me, I see financial stress and inflationary pressures. So yeah, I think it's an alternative currency, but it's also an insurance policy against some of these other, problematic events we were talking about with, corporate credit or whatnot.
The way things are right now, would the better buy be gold, physical gold, ETFs, or gold mining stocks?
I think the mining stocks are really just kind of, for me, a high beta play on the underlying metal. The stocks, the miners are cheap relative to the metal. And silver's cheap relative to gold. But all these things are just because the whole sector has been just left for dead. So I own some it used to be the Central Fund of Canada. It's now the Sprott Physical Gold and Silver Trust. The reason I like that is because it's you could trade it like a financial asset, but since it also trades at a discount to its underlying holdings of gold and silver, 3, 4, 5% or something. So, but then what I like about when Sprott took it over, they made a conversion feature so that you can convert your shares to physical bullion out of this. So you don't even have the type of worry that you might worry about with an ETF or something, because you always convert it to coins or whatnot. So I own that. I also own some miners because I do think they're incredibly cheap. And once gold breaks above 1350, the miners are going to just explode higher. I think you have to buy them now. There's a lot of people that are waiting for that breakout, but once you get that breakout higher in gold, it's going to be too late, because look at what the miners did in early 2016 when gold reversed. Gold didn't even, was basically just kind of making a new bear market low and then reversed higher. And the gold miners, some of them went up 200-300%, in a several weeks time. That's going to happen again when gold prices break out higher above this clear, resistance level everyone's looking at.
Okay. You mentioned you do own some gold. How much, the percentage of your portfolio, how much of it is in gold?
It changes for me. I mean, in 2015, I didn't actually own any gold at the time. I just had miners, but across a couple of mining stocks, I had about 30% of my portfolio. I have a very high risk tolerance. That's much higher than most people. I'm comfortable putting 20-25% of my money in one stock, and that's totally inappropriate for most people. Then I trade around that position size too. I only put on big size for a short period of time when I'm confident about the direction of price, and also quick to reverse if I'm wrong. So I think for the average person, 5 to 10% of your portfolio in gold in normal times is probably smart under any circumstances, just as a diversification tool. But I think it makes sense to be overweight gold right now. So I think anywhere from 20 to 30% of your portfolio in gold is probably pretty prudent right now.
Okay. Jesse, I hear the silver guys screaming. They want to know, how about silver? Are you positive on silver?
I don't. I'm very positive on silver, but I don't own any. I don't really trade it. It to me, like the mining stocks, is kind of just a high beta version of owning gold. And so I do think silver, when gold breaks higher, silver is going to go a lot faster to the upside. But it's really just depends on your risk tolerance, and I think it does make sense to probably own a little bit of both. Yeah. What's interesting to me right now is you look at the Commitment of Traders report, and commercial hedgers in silver look like they're getting very bullish again in silver, even more so than the commercial hedgers in gold. And so to me, that's a very good sign for both, but especially for silver.
Well, let's hope so. Last question. You mentioned, I think, gold at 1350. Any window where you see that happening in?
I think it's going to happen here soon. I thought it was going to happen last year, and then gold sold off pretty hard. People get so discouraged. Gold's making higher lows, since that 2015 bottom. So to me, I'm willing to be patient. But I do think right now, everybody, I think of it also in terms of the dollar. There's so many people that I talk to that are bullish on the dollar, and I just don't get it. The dollar's overvalued. You look at the positioning in the currency markets, and everybody is long dollars against euros, yen, everything. To me, that, or essentially short the dollar. I'm sorry, short euros, yen. I think we could have a short squeeze in those currencies that could be the catalyst for a breakout higher in the gold price. That said, dollar lately has been kind of strong, and I'm surprised gold hasn't sold off more. So I think this year we're going to see that breakout higher in gold. I don't know if it's going to be in the next couple of months or closer to the end of the year when we get that seasonal strength, but I think it's coming pretty sooner rather than later.
Okay, Jesse Felder, that's some great info there. Can you let our listeners know more about the Felder Report and the benefits of subscribing?
Sure. Yeah. I write a blog post. I try and do like one blog post a week at thefelderreport.com, usually geared towards these types of topics that we're talking about, things that affect individual investors. I also have my own podcast, which I've been on hiatus from for a little while, but I try and interview some guys that I just really think highly of and have a unique insight into specific topics in the market. But yeah, that's my site, and that's kind of what I try and do with it.
Okay. Are you active on Twitter where people can follow you as well?
Yes, I'm very active on Twitter. It's at Jesse Felder, and I tweet, a number of articles every day. I do a ton of reading every day, trying to pay attention to different trends and narratives in the markets. And so a lot of what I tweet is not necessarily what I believe, but it's things that I'm paying attention to, narratives that are driving prices across different markets. And so, I try and use the Twitter account for that mainly.
Okay. Jesse, we thank you for coming on the show and giving us your time this morning. And it's been an absolute pleasure speaking with you.
Thanks, Patrick. I enjoyed it.
That was Jesse Felder, publisher of the Felder Report. For more of his insights on gold and the global economy, please visit his website, thefelderreport.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And please do check us out on iTunes and Spotify.